Okay, we're live.
Okay, welcome everybody. The meeting of the Tax Review Commission is now come to order at 12:01 on July 25th. Our agenda, public testimony. Is there anything from the public to share with us today?
No.
Okay, then let's move on to the approval of minutes from just last week, July 21st. Any corrections, additions? If not, can I have a motion to approve?
Beth, the one correct, I don't know that it's a correction, but at the end it said the next meeting's August 11th, which is, I think, what we said, but the next meeting's actually today. So I don't know if that's a correction or not. So
yeah, did we correct that in the final version, Rick? Because
yes, I made that
right.
correction.
Okay. We did say that, but today's the meeting, so I think we wanted for posterity to set the record right. But thank you. So with that correction, a motion to approve.
So moved.
Okay, Alton, second.
Second.
Okay, thank you, Winston. All in favor, say aye.
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 Any opposed? Okay, motion carried. The next item on the agenda is discussion of hiring a tax review commission consultant. And I would like to recommend that we, rather than hiring a consultant, we work with the buyers, economist who is already working for the Department of Taxation. And I'd like to ask him to give us kind of a quick overview of his work and capabilities to do this for us.
Good morning or good afternoon, commissioners. I'm Baibars Karakovali, and I'm an economist here at the Office of Tax Research and Planning, which is managed by Dr. Seth Colby. I've been working for the department the last 3 years, but prior to that, I was an academic. So I was an assistant professor at UH Manoa for 6 years. And prior to that, I was at Fordham University, assistant professor in New York. I have a PhD in economics from University of Maryland. And I've been doing mostly academic research, but worked as a consultant for the World Bank over the years, both on-site and remotely. So that is my policy experience that I can translate, I guess, technical issues to more general audiences. And teaching has also helped, obviously. But the one thing that I've gotten over the years, the last 3 years, I got to learn a bit more about taxes, and I've been in charge of preparing the tax credits report and the GET exemptions report. These are annual reports that we prepare. Then I switched over to Hawaii Individual Income Tax Statistics Report the last 2 years, and have been doing revenue estimations for the legislature that deals with any of the bills that might affect the general fund, the revenues of the state. Mainly in areas of individual income tax and tax credits and GT exemptions. I worked extensively, even did some work for carbon tax that I'm familiar. We were in communication with McKenna Kaufman about that through Seth. So that's my brief introduction. So in terms of, so I'm employed by the Office of Tax Research and Planning. I'm not sure how the details would work, but Dr. Colby suggested that potentially I could assist the commission since we'll be doing the research, the underlying research, where we have access to the data that would be supporting some eventual papers that the commission might want to task a consultant with. So happy to meet you all.
Thank you very much. And my understanding is that you would be working for the commission as an employee of the department, and that we assume that this would require some overtime on your part, and so the commission would cover that cost.
I see, I think, yes. So for it to be over, so this would be additional time outside of regular work hours in compliance with the, state ethics code. So it would be overtime and outside of the business hours that I would be drafting the main report, potentially doing some additional work that you might commission on, for instance, tax credits or standard deductions, things of that sort, that might go as an appendix paper. All those would be performed outside of the business hours. The other part is that we are also, as an office, in support of any research that the commission is doing. So that aspect of it would be during business hours. That would then, the report writing and the consulting work would be out of the business hours. And
Okay.
my understanding is that it is paid over through overtime, but details we are not sure yet. We have contacted the human resources, how that might occur.
Okay, thank you. Does anybody have any questions for Bybars? Or for Seth, for that matter, is in terms of the arrangements that we're proposing here? Any
Yeah, so
concerns?
just as a quick point, you guys have maximum discretion over your budget, right? So my current thinking was to, you guys are reaching out to McKenna for the carbon tax study, and then if you had you still have ample funds, so if you guys wanted to hire another study, you can. I reached out, PFM, incidentally, the group that did the consulting work last time around for the major study, reached out to me a couple days ago and said they were still interested. So if you would like, I can pass their information to you, so you guys can contact them to consider that. What I really envision for Bybars, and I think what he'd be really good at, is just bringing everything together and writing the report, right? And helping you guys orchestrate and really structure your thinking. That role was performed by Don Rusling for the last Tax Review Commission. And so Bybars would be doing something similar then. So that's how I thought of this. And then just to let you know, as what TRC, the tax, or not, I'm sorry, TRP, the Tax Research and Planning Office, what we can support you with is individual numbers and doing different types of modeling and things like that. And that would all be within our purview, and we're happy to support you with those types of things.
Oh, okay. That provides a lot of clarification. Thank you.
Yeah.
In terms of the work provided outside of the normal working business hours, but would be paid by overtime, do we have an estimate or any type of budget for what that would run for the commission?
Seth, do you have any?
Yeah. So we're looking at that. I think it would, like, you guys have to come up with the scope of work for Bybars and make that a little bit more explicit. So if you guys wanted to just have him write your report, and the final report, which is usually like 15 to 20 pages, and bring together all the information, that would be one thing. If you want him to like orchestrate and systematize the knowledge that you guys have gained, I think that would be another type of thing. So before you can say how much, you guys have to say what you would explicitly want Bybars to do, and then it's up to him. And we could talk with Bybars. We could also talk with and we can go back and look at the past contracts, but I think the first thing to do is be explicit about what you're asking Bybars to do.
Scott?
Thank you, Chair. Just a quick comment, just because I come from the government side regarding procurement. Is this, are we subject to procurement where we can just sole source, or does this type of work need to be out for procurement? I'm not sure, so I'm asking.
last time we did not have to, this was more of a sole source project, right? Because this is related to overtime of an employee. So we don't have to do that with, we didn't have to do that with UHERO because they can create a memorandum of understanding because that's within the contract. And then even with the PFM group, we might be able to avoid having to go out in a bid because since they've done previous reports for us, as long as they're updating the report, we might be able to do a sole source. So if that was something that you guys were interested in, we could probably expedite that. The bigger things where we would have to do procurement would be in instances where if we really wanted to do a whole new study that's not updated and you want external consultants that are not found within the government, state government.
No, I appreciate that. I just wanted to make sure that we cover our bases. So thank you.
And that last option you just mentioned, Seth, I don't think we have time for. I mean, just
Yeah.
getting McKenna to update the existing carbon tax study and do a little bit more work. Maybe getting PFM, was it PFM? Did I get that right?
Correct.
Maybe getting them to update some of their stuff. I mean, we'll be squeezing that in to get that in by the end of the year. A brand new study and then going through procurement, there's just no time for it realistically.
Correct.
I'm a little bit confused about what analysis you're saying staff can do as part of your regular jobs as opposed to what we might ask BIBARS or PFM to do.
Great question. So if you guys asked us to look at, for example, if you guys are looking at standard deductions and doing the indexing the tax brackets to inflation, that's something that we could totally do in-house, and that's what we would be doing, right? So any type of modeling, any type of like revenue forecasting for changes in the tax law, TRP would be responsible for doing that. In terms of like actually writing the report and systematizing the knowledge, that's kind of what that's what past people have done. So it's not the modeling or the research. That's part of our job. And that's part of our job to support you, right? It is not, given historical precedent, it's not part of our job to write the report for TRC, right? And it's not part of our job to systematize the knowledge. That's something external. And that's why I encourage you guys to get a consultant if BIBARS is the best candidate. If you guys decide that BIBARS is the best candidate, we can use that going forward. Does that make sense, Beth? Or do you need a little bit more clarification?
I think that certainly provides a lot of clarification. One question I do have, and that was for just the things that we've identified as our priorities. I think that it would be helpful to go back to past commission reports and see what they said about any of those things. And also to see what PFM said, at least the last time. So I'm wondering, is that something staff would do, or is that something that BIBARS would do?
I think that's something that BIBARS would do, or the
Okay.
consultant would do, yeah.
Okay. Okay, I think I'm pretty clear. With that then, I would be very happy to take a crack at putting together a scope of work that we can approve at our next, or discuss, change, approve or not approve at our next meeting. Shall I go ahead and do that?
I think that's a good idea.
Okay. Any concerns about moving in this direction?
That's fine, but Seth, can you share with us the contract with the last consultant? I guess it was Dan. So we can get
Don,
another.
no, I
Don?
actually requested about that. There's no consultant. They just paid him overtime, right? And so
Oh, so there was no engagement letter, so there's no scope or anything?
I asked at least the procurement people could not find that. So
Okay.
I don't know of anything about that. He did, so Don Rusling did two separate consulting projects. One, he looked at, and this is included in the appendices of the last TRC. He looked at, should Hawaii get rid of corporate income tax? And he did a study on that. And he was compensated $10,000 for that one. And then for writing the report, he was compensated $15,000 for writing the report. But again, I think before you talk about actual dollars and cents, I would suggest you get very explicit about the task that the scope of work for the upcoming consultant, and then you guys can liaise with by bars and stuff. And as long as it falls within a reasonable range, then we can take care of that.
Okay.
As it might be related, I'm hoping someone can remind me the scope of the PFM report. I read the last 2 Tax Review Commission reports, and I read the PFM report, but it's been a little while. Doesn't that cover a lot of the topics that we're currently looking at, discussing? Because I think at least 3/4, maybe even more of most of the topics other than the carbon tax that we're looking at are topics that I think one or more of us pulled out of past Tax Review Commission reports. And if most or all of those were covered in the PFM study, then an update from them on those topics would cover the vast majority of our topics, plus the carbon tax, and then maybe by bars to, tie it all together. Is that what we're talking about, or is there some other scope or some other thing contemplated for PFM?
I'm wondering whether the updates from what PFM did the last time, whether that would be something the staff would do, or whether we would need to contract with PFM to do that.
Yeah, I
So-
would suggest you guys go look through the PFM report. I mean, it's a long report. It's about 100 pages, right? So it's significant, and figure out what numbers you would actually like updated. So PFM, there's disadvantages and advantages of using PFM group, right? So from my perspective, they're a little slower, and they still get all of our data from us, right? So we just pass them on the information, and they do something similar to what we would be doing. In fact, in some cases, they use less exact numbers than what we would be doing, because we have better access to data. I think the PFM group has because they look at different tax systems, they can provide they're very good at providing a comparative analysis, like looking at across different states. And if you really wanted something like an independent, they're independent, right? And I work for the Department of Taxation, right? So if you really want something independent about giving opinions and stuff, that's what I would suggest you to engage PFM on. I don't know what their turnaround would be like. I don't know what they'd be willing to do and different things like that. But even with PFM, even if we didn't have to do a procurement bid, my guess is it's still a pretty tight turnaround, right? If you guys are still trying to meet the deadline of mid-December, and to be fair to buy bars and the person writing the report and you guys voting on the report, you pretty much need all the information by early to mid-November, right? So that gives you 3 months.
Yeah. Okay, so any other comments on this? Otherwise, just to sum up, I will draft a scope of work that we can have more discussion on. It would behoove us all to go back to the PFM report and see what they had to say about the issues that we have prioritized for this year's commission too. And make recommendations on whether there's value in seeing what PFM can do for us.
And Beth, would you like me to give you PFM's contact information so you could and reach out to them, or would you like to hold off on that?
Yeah, you can go ahead and give me the information, and if I think that would be indicated, I will go ahead and do that before the next meeting.
Great.
Thank you. Okay, well, let's move on then to discussion of standard deductions and personal exemptions. Kate, are you or Bybars starting this discussion?
I think Bybar's slides that he prepared, which in all fairness, I should have, I wish I would have seen before, but it's great info. I think it gives us a good background for the discussion. So Bybars, if you're okay to go first with the overview, that would be great.
Sure. I mean, this is again just the background, and I just quickly pulled them this morning, but hopefully it would set the stage for the discussion. I've seen the memo that you have written, which you'll discuss after this. Let me share my screen. Is this visible by everyone?
Yes, thank you.
Okay. So the standard deduction amount in Hawaii is based on individuals' filing status, and these are the current rates. But if you look at it over time, they have not changed since 2013, and they're somewhat infrequently changed by statute. They're fixed by statute. They are not adjusted for inflation, and I think that is being raised as one of the concerns in the past. Unlike the federal standard deduction amounts that are adjusted annually for inflation. But I just wanted to see how there's still some increases, significant increases infrequently over time. And I wanted to see how it compares to the average inflation rate, US inflation rate. And overall, once we look at the average growth rate in the actual deduction amounts, they have outpaced inflation, at least in terms of standard deduction in Hawaii. If we look at the, there are more details, so that would be part of a more detailed presentation or a study that can be discussed. But there's this interplay between standardized versus itemized deductions. And since the standard deduction amount has not changed since 2013, the adoption rate of standard deductions have been somewhat declining from 47.5% in 2013, the dark bars, down to about 44.7% of all returns in 2019. If you look at the dollar amounts, the total standard deduction that was taken was $850 million, whereas the allowable itemized deductions were $6.8 billion. So again, there's an interplay. There's certain changes that are happening in the federal realm. So that's why I wanted to juxtapose that with the federal deduction amounts over time. Pretty much they have been on par with the inflation rate, maybe falling a little short of the inflation rate over the years, with one exception. In December 22, 2017, we had the Tax Cuts and Jobs Act, which has basically eliminated personal exemptions, but have significantly increased the standard deduction amounts from about 12,700 for joint filers to 24,000. So that was one major change. But if I take out that big jump from 2017 to 2018, the average growth rate was somewhere about 1% a year of the standard deduction amounts in federal rates. Now, a quick note about personal exemptions. So in Hawaii, we have personal exemptions for the taxpayers themselves and their spouse and their qualified dependents, and for being aged 65 or older. There's also a special disability exemption. Overall, about 95.1% of the resident returns have gotten exemptions, and it comes to about 2.1 exemptions per return for a total amount of $1.6 billion. The exemption amounts, how have they fared over the years? It was raised in 2013 to 1,144. So this is so someone might have themselves, their spouse, 2 children, and they might be over 65. So you would multiply this number 1,100 with your total number of exemptions. So in this example, it would be 5 times 1,144. And the last time it was changed was in 1985 to $1,040. So this this personal exemption amount has clearly fallen short of the pace of the inflation. But as I mentioned earlier, in 2017, end of 2017, starting tax year 2018, federally there are no more personal exemptions that are out there. So hopefully this would provide some of the numbers that Commissioner Lloyd was mentioning in her memo, and hopefully this would help you with the discussion. This is all I have. Thank you. Oh, yes. Sorry.
So one of the questions I guess I have is, you showed good comparisons between the growth rate of the personal exemption or standard deduction and inflation, and you showed, you know, what the federal has been, but there's a difference or an issue not just with the growth rate, but the absolute level, which is obviously a small fraction of what there is in the federal side. Now, I think in a previous discussion, Seth commented that because those numbers are so low, there's been other, whether it's tax credits or other subsidies that go to the poor to compensate for very low standard exemptions and standard deductions and personal exemptions. So if we revise these or recommend they go up and index them to inflation or something, I mean, indexing to inflation just seems to make sense across the board. It's sort of silly to do it very infrequently and then have these big jumps where, you know, it goes up a lot from one year to the next and doesn't change at all for years on end. It just doesn't make any sense. So the inflationary fix makes sense. But if we were to increase the absolute levels, I feel like, Seth, that in a previous discussion, you commented on how we would have to change some of those other subsidies, if you will, to prevent an oversized windfall, if you will, to the bottom, whatever decile or quintile people. Is that, am I remembering that right, Seth?
Yes, so that is true. If you lower, I mean, the way I think about this is you're looking at their overall tax burden, and there's a number of ways to adjust a person's tax burden. One of them is tax credits. Tax credits can be very, very focused, and you can do that by income and by all these type of stipulations, right? There's standard deductions and personal exemptions, which everybody gets. So if you're really only looking at, we want to benefit a certain portion of low-income individuals, everybody will benefit from the standard exemption and stuff. So, right. So it's very hard to target that. That's why they tend to not mess with these very often, because the minute you mess with them, they're expensive. Right. And then finally, there's another way you can also do it, which is just the tax rates. Right. So every year, because of our tax rates are not indexed to inflation, all of our tax burdens are going up. Right, because most people get like a 1 or 2% pay increase a year on average, but like the tax rates are staying the same, so everybody's taxes are going up, right? So you can think about the way I think about it is there's 3 ways to adjust the tax burden. The tax credits tend to be the most focused, and the other 2 depend on things. And so you could figure a way, you know, in some ways past TRC commissions have asked us to look at ways where, let's increase the standard exemption amount, but adjust the individual income tax bracket so it's not a huge monetary loss, right? So there's a lot of different variables at play, and I think it's important to think about all three and the advantages and disadvantages of using each one. The final thing that I would say that is, because we have a very low standard exemption through the W-2, unlike the US government, we tend to collect more in individual income taxes than there is tax liability. And why is that? We think that's because there's a lot of temporary workers that come and work here for a couple months that never file their come and file their taxes, and they would be, if they did file their taxes, they would have the right to receive large refunds, right? So just because that's our current hypothesis, but it ends up being like 100. It's not insignificant. It's like 100 million or 150 million dollars extra a year of people who we've collected their taxes, but they don't match liability. And that is because of our low exemption rate. So on the W-2s, we just withhold, everybody gets withholding a little bit more.
Interesting. Kate, would you like to go through your memo and the things that you were thinking in terms of this subject?
I can, and I don't mean, I don't, there's no reason to go through the memo in detail. I mean, I think Seth sort of, and Bybar's provided the context. I think the question is, and I probably have one of the easiest ones, is both of the most recent prior two commissions recommended increasing the standard deduction and personal exemption. The PRFM study, or the PFM study, actually said that is the optimal method for decreasing regressivity in our tax system. So, and yet we haven't done that. It sounds like it's a super complex analysis to do. It does seem like an issue where if we could make a recommendation, do the analysis, and if we think that we can make a specific recommendation, it might be one that is straightforward enough, clear enough, the numbers are clear enough that the ledge might actually pick it up and act on it, which is, I think, another challenge of the prior studies, is that, all this great analysis gets done, but I just don't see much happening. And so it just looked to me like an issue that was fairly straightforward, fairly ripe for assessment. Although now I see Bybar's slide, which, the statements about not keeping up with inflation may not be as correct as the prior commissions thought they were. I think it's an issue, again, that's ripe to sort of do some basic analysis on a couple of different levels. It sounds like from what Seth said, that would be his department that could do that. If we raised it to X, what's the revenue loss? How many affected? If we raised it to Y, what's the revenue loss? I think one of the prior commissions did recommend matching it to the federal. That was before the federal doubled in size. Certainly, I don't think, that we could match the federal at this point. I think the revenue loss from that would be too much. But I think wherever we end up with raising it, I do think recommending again that we index it to inflation, as Murray said, to stop those sort of go, and then big jump and go. It just makes sense. I think the last thing that I'd sort of like to hear from on the indexing for inflation side from Seth is, does that automatic index for inflation every so years, does that add to the complexity of administration? Because you've got to change all the forms, you got to change all the calculations, you got to change everything. Is that one reason why we haven't indexed for inflation in the past?
I mean, I would say my colleagues would say that it's complex, but it's actually really straightforward. You're just changing
Okay.
you're just changing a couple numbers, right? And that's pretty easy. And like you can because most people use tax software, right? Even people who are professional CPAs, nobody calculates their own brackets by hand really anymore. So it's a pretty easy thing that we could update every single year.
Okay. Again, it's not earth shattering, but I just think because it's been repeated over time, it's been identified as an optimal way to deal with regressivity, which is one of my sort of main issues. It just is one that I would like to recommend that we have Seth's department do some updated numbers for us, and then see what the revenue loss would be, and whether that could be justifiable.
And Kate, did you have specific parameters that you'd want them to explore?
I think in the document they in one of the prior studies they had done an analysis. I don't remember the amounts. I think it was increasing the standard deduction to like 7,500. And they estimated a revenue loss at 61 million. I think we could repeat that analysis. That seems like it would be pretty easy to do. I think just for observation's sake, we could see what it would be like to match it to the federal. Again, I can already imagine that the revenue loss there would be too significant. And then maybe just some number in the middle.
And just to be clear, Kate, when you say match the federal, that means getting rid of the personal exemptions?
Yeah, I mean, I
Okay.
think if that's what they've done, you know, because it wouldn't be fair to say, yes, match the federal's deduction and then keep the exemptions, you know.
Okay.
But when we say match, are we talking about matching relative to this recent big jump or right prior to that big jump?
I think the big jump is when they eliminated the personal exemptions. And again, I don't believe that based on what the analysis will show, I think that change would simply be too big of a revenue loss. But I think it would be interesting to see, because that is what they suggested in the last study, was matching the federal. Well, now the federal's gone way up here. So I think just as a data point, that would be something that we could have Seth's office look at.
And to my previous comment, I agree with that. Then to my previous comment, Seth, is there some cleanup that would then need to take place? So, and I don't understand this obviously as well as you do, but my sense is there's been a lot of Band-Aids that have been stuck on the tax code to deal with the fact that because we have such a low personal exemption, standard deduction, low-income people are taxed really early, you know, before they make very much money, they start getting taxed right away. And so we've done various things, is my sense, to the tax code to sort of undo that or give the money back or give them a credit or protect them from that. And so the net of our really low standard deductions, personal exemptions, and all this other stuff might, you know, make the actual tax level kick in at a higher dollar amount than it appears to from just the standard deduction and personal exemption. So if we jump up to this federal level, is there some of those Band-Aids that need to come off to keep from just sort of overcompensating for low deductions that would be no longer low?
Yeah. So as things stand, the EITC is non-refundable, right? So if you get rid of their tax liability, they just can't, they're not going to be able to claim it until further years. The food and excise tax credit is actually for the GET. So unless you wanted to move that back, I don't think that needs to be really adjusted very much. So my recommend, unless the EITC was refundable, I think that's a slightly different analysis, but since it's non-refundable, by lowering their tax burden, you really do not need to get rid of the taxes or any of the other credits or anything like that.
And the integration with the EITC is one of the other things that I was curious about, because I think that the last study was done before true implementation of the EITC, right? So I'm not sure about that, but so that would be another data point that I think would be interesting is if we raised the standard deduction, are we really benefiting lower income folks who would have gotten that relief from the EITC anyway? You know, how many folks are we really benefiting? That it's an interesting data set, but I think the other point is to get the benefit of the EITC, a low income earner has to have their wages withheld for a whole year, file their taxes, get the EITC, and while it may be non-refundable, you know, in terms of they don't get money back over their withholding, it's still less money in their pockets on an ongoing basis than there would be if we weren't withholding as much in the first place.
Can I just add a quick note that I'm not sure what methodologies they had used previously, but we currently have, we are able to use micro simulations and actual tax return data at a very granular level. So look at the kind of come up with counterfactual or synthetic tax liabilities that would occur, taking into account all the different tax credits that they're taking, what they're, you know, how that would adjust their taxable income, and you can only claim up, you know, non-refundable credits up to your tax liability. So all of those things would be taken into account rather than some. So we're able to use, I guess, confidential data at the individual level, and then aggregate that to come up with a number. So hopefully we would have a much more accurate picture. But the other advantage that it provides us is that you can actually provide statistics by different groups and how they're affected. So you can say how much a qualified widower making between this much and this much, how much their tax liability has changed. So, you know, to be able to answer those questions that you would not be able to answer if you just look at averages and totals. Like, yes, this will cost 50 million, but how is that going to affect different segments of taxpayers? So we're able to do that.
That would be great. And then Seth, going back to I was sort of really surprised about the $100 million in people who don't ask for their money back. I guess my concern there is it really the temporary workers, or is it people who don't understand that they need to file taxes to get their withholding back? I don't know. I don't know how we explore that, but
that's just something we do. I mean, we could look at different things. These are my priors that people who are entitled to the EITC, there's a lot of private sector entities that are very proactive in helping people get the federal EITC, right?
True.
So there's a lot of private, and we actually offer services to allow people to do this, right? So that's at the federal level. In the EITC, and now with the child tax credit, that's significant, and there's actually people who like call up, you know, lower income people and said, hey, you want me to do your taxes? I can get your money early. So if you do that at the federal level, they'll also do that usually at the state level too. But that's just my priors. There's no way of saying that maybe, yeah, it's low income people that just haven't filed taxes, which is a total possibility, right?
Got it.
If you really look at who doesn't file taxes, it's generally low income single filers, which is what you would
presidential candidates too.
Yeah. And in low income single filers tend to be either people living, you know, kids who just don't file their taxes because they're living with their parents and they've only made a couple thousand, you know, $10,000 or something, or people who made something elsewhere, come here, make it a little bit, and then go back to their states. So what we see in the data does conform to kind of the picture I was painting. That doesn't mean it doesn't happen. And in any type of tax analysis, taxes are really, really complicated, right? So taxes can benefit 98% of the population, but 2% can be totally screwed by it, just because every single tax situation is really unique. The other thing that we will do, and we'll try to accommodate, and this is a really important part, is when you increase the standard deduction, a lot less people use itemized deductions. So if you looked at our analysis, about 50% of the people use itemized deductions. We're at the federal level nowadays, it's like 20%, right? Because unless it's a lot harder to use your itemized deduction. So that's something that we'll go ahead and try to model as well.
Does that reduction in itemized filers save dough tax money or effort, or how does that work?
No, it's just like whatever people put down on their things, right? So like if you guys do TurboTax or whatever, they say, oh, we're going to save you all these money, and they ask you questions. And then at the end, they may say, oh, we think it's in your best interest to do standardized deductions or itemized deductions, right? The higher it is, the more likely you are to do, the higher the standard deduction, the more likely it is people use standardized deductions. Hawaii, we probably have one of the higher rates just because the standard deduction is so low.
And our mortgage rates are so high.
Yeah, exactly.
Yeah.
And you know, think about this, mortgage rates, we all think about mortgage rates because most of us are mid-career professionals here, so we care about that, right? But you know, the majority of tax filers do not have, taxpayers do not have mortgages. They're single people who are just living with somebody else or renting, right? The biggest dollar figures are joint filers who do have mortgages, and those are the people who itemize their deductions, right? And the interest rate deduction is the largest single deduction in dollar terms that we have, but not in terms of like the amount of people who claim it.
I am sort of wondering why the federal government decided to get rid of the personal exemption, and sort of the pros and cons of doing that. I'm assuming that if you keep the exemption, then larger families or larger households would be benefited. But are there some other nuances here I can't really understand?
One is simplicity. So a lot of, you know, the people who were past the tax Jobs and Cuts Tax Cut and Jobs Act, whichever, TGCA, explicitly said that they wanted to simplify things. So if you just have one standard exemption, that's a lot higher. It's easier to figure things out. But you're kind of right that it would penalize people with more standardized that can claim personal exemptions.
Yeah, we're not here to complain about federal taxes, but it penalizes big families and rewards single people.
In that one, but they also have, like, you know, the EITC is basically for families, right? Before the latest go around, if you were a single person, it was very difficult for you to get any EITC money. We do have the child tax credit. So, and I think that was increased a little in the last reform. So again, they were looking at this whole big picture and kind of shifting different things around. And so you can't just look at one thing and say, oh, well, you can look at, say, one thing, which is a standard deductions that it penalize families, but unless you looked at the whole entire legislation, you wouldn't know if that would penalize families or not.
There's also the fact that the itemized deductions were adjusted quite, radically. Yep. So they had to kind of they put a cap on how much of the local and state taxes that you can deduct. So there's definitely political issues that were involved in there as well. So, and you're absolutely right, Mary, that it would be penalizing the large families at the expense of single people or, just simple joint filers.
Having 5 kids, I speak from personal experience. It's definitely worse. And I don't get any of those child tax credits. Those are phased out. So
Darn.
Yeah. Well, so if the rest of the commissioners are willing, I'd actually love to work with Bybars and or Seth and figure out sort of what kinds of analysis we could run, a couple of different scenarios on raising the standard deduction and personal exemption, maybe one scenario with just raising, matching to the federal and eliminating the exemption, and then maybe something in the middle, and just sort of look at, as Bybar said, the impact of that across certain specific filer types, and then as well the revenue loss. A secondary one I had put in there was, then do we look at the rates, index those for inflation, and or try to achieve a little bit of tax neutrality by increasing the rates? That one clearly is going to have some political challenges associated with it. So I'm not as interested in that as much as but I don't know, if our proposal came up with a $75 million revenue loss, are we then supposed to sort of also say, and we can make up from that with that by Murray's carbon tax that's going to bring off a bunch of new revenue into the state? I don't know how much we try to keep it neutral.
Go ahead, Murray.
I have a tendency to talk too much, and I apologize to the other commissioners. But when we first started talking about standard deductions and personal exemptions, I think I made the case that I felt like it was really unfair that we tax defined contribution, retirement, but not defined benefit. And one of my hopes was, because if you start taxing antes, retirement, and antes never been taxed before, it's going to be super unpopular. But I think we figured out from the previous report that change would be worth over $300 million a year if they were to tax defined benefit plans like pensions as well. And so when I was thinking about it, I was thinking about it as almost an offset. So you raise the standard deduction, so the low income retirees actually are protected by that higher standard deduction. They don't get taxed really, the low income retirees, even though you're saying I'm going to treat defined benefit and defined contribution the same way. And so I was curious in how you could offset some of that. So you could say, hey, we're taxing defined benefit and defined contribution the same way, but the low income retirees will be protected by this higher standard deduction. So I was curious about that, but if that's biting into a whole nother bad apple or whatever, then forget it. But that's kind of the way I was thinking about it, is you've got revenue loss from the higher standard deduction, but if that protects those retirees, they're going to call up and complain that why are you going to tax me now? Maybe that helps. I don't know. It was just one idea.
Yeah, I think that we had talked about seeing how an entire package would work out in terms of increased revenue or decreased revenue or neutrality or whatever, and increasing equity. I guess the jeopardy there is whether legislators pick and choose from among the recommendations, and it's no longer balanced in the way that we might have proposed.
I think we have a pretty good idea of what you're trying to do. So we can just do a bunch of different models and present to you what we find, and then you guys can make your recommendations based on that. So if you give us some leeway, I think we can just come up with play with a number of different scenarios and then give those scenarios back to you. And then if you have further questions, we can do that.
Okay, that sounds great. And
does
Kate,
sound
so
good.
you will be working with TRP to come up with some scenarios and work out some of the details.
If it's necessary, but Seth, I mean, it sounds like you kind of get, you kind of get where, what
Yeah,
analysis would be helpful. And so,
yeah, exactly. What we'll do is we'll start off, what we usually do is we take extremes, right? So we go all the way to the federal exemption, see what the loss is, see what the implications are, then pick something halfway in between,
yeah,
keep a couple the personal exemptions, but just actually raise the standard deduction, what that would do. So we'll just play with a bunch and then see what happens.
excellent. Thank you.
And then the other thing, Murray, in terms of, or in all of you guys, is if you really think like politicians, right? And you wanted to do like the retiree thing, is you just say like everybody who currently is, it's hard to take things away from people who already have it. But what a lot of things happen is like, for example, when the federal government limited the standard, the interest rate deduction on mortgages, right? If you already had a mortgage, they didn't touch it. It's only for mortgages issued after a certain date. So if you wanted to do something with, get closer to parity, one idea is to say, okay, starting in 2023, all pensions will be taxable or something like that, right? So it's not like you're taking away for the 90-year-old grandma that already is like relying on things. You're assuming that like, okay, if you do retire, you're going to have to take in these taxes into account going forward. And that just tends to be a lot more politically palatable. So that may be something that you guys want to consider going forward. The immediate gains would not be large, but you guys are really tasked with thinking about the tax system on a generational timeline, and in 30 years there should be a turnover, and at that point, if you can get to parity over 25-30 years, that might be another approach.
Yeah, that's a very good point, and something that as our population ages, it needs to be thought through a little bit.
Yeah, future effective dates certainly have merit. I get it.
Okay, then I think we have taken care of that issue. Let's talk about the next meeting. We are scheduled to meet on August 11th.
Beth, can I ask one more question? So we will
Please.
work on that with the goal of getting something to you in early September. Does that sound reasonable? Okay.
Good.
Thank you for being willing, because we're pressed for time. So
yeah.
Thank you.
So I have the next meeting as August 11th, and I believe we are going to talk about compliance and enforcement, and Sale and Alton are going to be leading that discussion. Is that your understanding, Alton?
It's going to be Sale.
Oh, okay.
I'm doing the Simpson boils, and he kind of volunteered for that. So
okay.
Yeah, he'll take care of it. Thank you.
Okay. Okay. I would also like to suggest that we have a presentation from the people who have been working on visitor green fees on that date. They did finally get back to me, and they said that they've been making a lot of progress, so they would be available on that date as well. So I'd like to add them to the agenda. And my understanding from staff is that we can have a face-to-face meeting at the department on that day. So
Rick,
I'm excited to actually meet you.
No, that day was not available. The
Oh,
18th
no,
was
not that
available.
day. Okay.
What day was available, Rick?
August 18th.
The 18th is available, not the 11th.
Okay. The 18th was when we were planning to meet after that, and we need to check to make sure that we can have quorum on that day, because I think a couple of people have indicated that they can't be there. Kate, you said you can't, and I think Scott?
I think that's correct.
Okay,
Yeah, I will not be available on the 18th.
okay.
I can check any dates that you guys want to provide. I can check for you guys.
Okay. Just offhand, would August 25th work better? Is that a conflict for anybody, August 25th?
I'll still be on the mainland, but I won't be in flight, so I could probably join via Zoom. But if you're going to do that one in person, then I wouldn't be able to do that one in person.
I think when we meet in person, we still are able to have a video conference presence as well.
Okay, so I could participate via video.
Okay,
Beth, I'm not available on the 25th. But
Okay.
please go ahead.
I am for now. The sooner we schedule stuff and lock it in, the better for my schedule. But I'm presently available on the 25th and the 18th. But it sounds like the 18th doesn't help.
okay. Well, let's, you know what? Let's keep the 18th.
So Beth, can I interrupt? What is our quorum requirement?
Seth, is it a simple majority?
Yeah, it's 4 people.
Okay,
It's 'cause
great,
there's 7
thank
people
you.
on the thing. And
Okay.
the quorum means that it's an official meeting that you guys can deliberate and vote on, right? So if there were to be a date where only 3 people could attend and you can receive public comments, you can receive a public presentation, all of that can be documented. You just cannot vote on things.
And we could still have a discussion about any information. We just
Yeah.
couldn't
Mhm.
conclude anything. Okay, I think then we need to keep the 18th as we had originally planned, with apologies for those who are not going to be able to join us. And so Rick, if we can meet face to face, let's give it a try.
Okay, the room is reserved for that day.
Okay, great. Thank you. I believe that brings us to the end of our agenda. It's 1:03 p.m. and I want to thank all of you for joining us today, and the meeting is adjourned.
Thank you very much.
Everyone.
Thank you. Bye.